Chapter 1. The Myth of the Benefit. You pay the price. Employer-sponsored health insurance is often portrayed as a generous gift or perk from employers. This opening chapter debunks that notion. What's labeled a benefit is in fact financed by workers themselves through lower wages. By definition, a true benefit is something provided by an employer in addition to your wages. Yet with ESI, employers simply reallocate part of your compensation to pay insurance premiums instead of adding extra on top of your salary. Economists widely agree that employees ultimately bear 100% of the cost of employer health insurance in the form of reduced take-home pay. In other words, the money for your health plan comes out of your paycheck. It's a hidden wage deduction. This chapter explains how that hidden cost originated and why companies call health coverage a benefit to begin with. We'll use a simple example to illustrate. If your employer weren't spending, say, $5,000 a year on health premiums on your behalf, that $5,000 could instead be part of your salary. By chapter's end, it will be clear that far from being a generous freebie, ESI is a sleight-of-hand trick. You foot the bill through foregone wages, even as it's packaged to make you feel your employer is doing you a favor. Let's start with the basic definition of a benefit. According to Merriam-Webster, an employee benefit is a service, such as health insurance or right, as to take vacation time, provided by an employer in addition to wages or salary. In plain terms, a benefit should be an extra, something given on top of your regular pay. If your boss gives you a $500 holiday bonus in addition to your normal paycheck, that bonus is a true benefit. It's extra money that you wouldn't otherwise get. The myth with employer health insurance is that it's an extra like that, a generous add-on. But in reality, it's not extra at all. It's part of your total compensation package, funded by the value of your work, just like your salary. Calling it a benefit creates the illusion that your employer is doing you a generous service, when in fact you are paying for it through compensation trade-offs. Think of it this way. If an employer could somehow stop providing health insurance but keep everything else the same, could they just pocket the savings? In a competitive job market, probably not. They would likely have to offer higher wages to attract and retain employees. That's because the money used for health premiums was effectively your money to begin with, allocated to you as part of your pay package. Calling the insurance a benefit is a bit like a friend saying, "I bought you a gift with your own money." For example, imagine a friend owes you $100 for helping them move. When paying you back, they hand you $80 in cash and a $20 gift card, proudly calling the gift card a special benefit for your help. You wouldn't be fooled. You know that $20 simply came out of the $100 you were owed. The total value you received is still $100, not $120. Employer health plans work the same way. The company's contribution to your insurance premium comes out of the total amount they're willing to pay you for your work. It's not an extra reward. It's a slice of your own earnings being routed to an insurance company on your behalf. Most people don't realize this. In fact, studies and policy analyses have found that few workers understand how much their employer spends on health insurance, or that those costs ultimately come out of their wages. It's easy to see why there's confusion. Pay stubs show deductions for the portion of premium you pay, but the much larger employer portion is usually invisible in your take-home pay. It feels like the company is footing that big bill, but behind the scenes your employer is balancing a labor budget for your position. If health insurance costs go up, something else, usually wage growth, gives way. As one report bluntly stated, the nearly $1 trillion that employers spend on health benefits each year comes from workers, not from employers. Employers finance spending on health benefits by reducing other forms of employee compensation, typically wages. In short, you pay, just through a less visible mechanism. The next sections will break down how this works in practice. Total compensation, one big pie and you only get the slices. To understand why employees bear the cost of ESI, we need to look at the concept of total compensation. When a company hires you, they think in terms of the total value of your compensation. This includes your salary plus any benefits, health insurance, retirement contributions, paid time off, etc. You can picture your total compensation as a pie. One slice is your direct wages, cash salary, and the other slices are the various benefits. The key insight is that the overall size of the pie is fixed by the employer's budget for your role. The employer isn't going to keep enlarging the pie for every benefit. Instead, they reallocate slices. Think of it from the employer's perspective. Say a company determines that a particular job is worth $60,000 a year in total compensation based on the role's responsibilities and market rates. That $60,000 is the price they are willing to pay for that labor. How they split that $60,000 can vary. All cash, no benefits. The company could offer $60,000 straight as salary and no health insurance. You get all of it in your paycheck, ignoring taxes. Cash plus health benefit. Alternatively, the company could offer $55,000 in salary and also provide a health insurance plan that costs them $5,000 for the year. You still get $60,000 total, but it's $55K in cash and $5K going to an insurance company for your benefit. Either way, the employer's total outlay is $60,000. In the second scenario, that $5,000 insurance premium is coming out of the compensation pie. It's money you earned through your labor, which the employer is using on your behalf for insurance. The result? Your paycheck is $5,000 lower than it could have been if no insurance was provided, because part of your compensation was diverted to health coverage. In this simplified example, you effectively paid $5,000 for your health insurance. It just never showed up in your pay stub as wages to begin with. This trade-off is how benefits are funded. Economists describe it as a compensation bundle or package. There's a fixed pool of compensation dollars for each job. If something is added to that package, like a new benefit, something else, cash wages, will be adjusted downward so the total stays in line with the value of the job. Far from being a gift outside of what your work earns, the health plan is purchased with your work just like your salary is. Let's reinforce this with a relatable scenario. Suppose you are choosing between two job offers. Job A offers a $70,000 salary, but no health benefits. Job B offers a $60,000 salary and includes health insurance. At first glance, Job B's benefits sound attractive. Many people instinctively value the insurance as a perk. But look closer at the math. If the health insurance plan is worth $10,000 per year in premiums, then Job B's total compensation is roughly $70,000, $60K salary plus $10K insurance. Job A's total compensation is $70,000 all in cash. They are essentially equal in total compensation value. Job B is not truly giving you more. It's simply giving you part of your compensation in a different form. In fact, Job A might feel better in your wallet because you see all $70,000 and could buy insurance of your choice. Job B's approach funnels part of your $70K package directly to an insurer. The crucial point is that either way, you ultimately earn and pay for whatever insurance you get. If a company tried to offer a low salary and no benefits without raising the total pay, they would have a hard time finding workers because workers implicitly expect that if benefits are missing, the salary should be higher to compensate. This dynamic shows that benefits are part of the market compensation for labor, not a bonus from an employer's charity. The relationship between employer insurance and wages isn't just theoretical, it's supported by substantial economic research. Economists have a term for figuring out who really pays for something: incidence. Numerous studies over decades have examined the incidence of employer-provided benefits, and a consistent finding is that the cost lands on the employee. In the case of health insurance, workers pay for their health insurance costs through reduced wages, according to economic research summarized by the Federal Reserve. In plain English, every dollar your employer spends on your health coverage is effectively a dollar less that they pay you in cash. Over the long run, as health insurance costs have risen, this trade-off has been a factor in why wage growth has lagged. A chunk of what could have been raises is instead going to insurance premiums. One analysis from the Center for American Progress put it succinctly: as premiums rise, they consume a growing share of total compensation, cutting into employees' take-home pay. It's important to clarify that this doesn't mean your boss is maliciously scheming to cut your pay. Often employers themselves may think they are contributing generously to employees' well-being by offering benefits, but the labor market forces and business budgeting work out such that those contributions are coming out of the overall pay budget for employees. Think of a seesaw. On one end is your wages, on the other is your benefits. The total weight on the seesaw corresponds to your total compensation. If the weight on the benefits side, like health premiums, gets heavier, the weight on the wages side goes down to keep balance. Your employer's total spend on you is the fulcrum. It stays roughly constant. Another way to view it is through your employer's accounting. Companies generally treat benefit costs as part of employee compensation expenses. For example, If health insurance premiums increase by 10% one year, the company's cost of employing each person rises. In response, they might give smaller raises or none at all, effectively letting the extra benefit cost replace what could have been a pay increase. This isn't personal or vindictive, it's just how the compensation math works out. Over time, employees may wonder, why isn't my paycheck growing? One little discussed reason is that a significant portion of compensation growth has been going into benefits, especially health insurance, rather than into salaries. In other words, you've been getting raises, but they've been absorbed by the escalating cost of your health plan. To see the hidden trade-off in action, look at the breakdown of premium payments. Often you'll hear something like, the employer pays 75% of the health insurance premium and the employee pays 25%. On the surface, it sounds like the employer is covering the bulk of the cost. For instance, in 2021, the average employer-sponsored family health plan premium was about $22,000. Employers on average paid roughly $16,000 of that, while employees paid about $6,000 directly through paycheck deductions. Many workers interpret that as, my company gave me $16K of value for free, and I only paid $6K. However, from the economic viewpoint we've described, that $16,000 came from the same pool of money that could have otherwise been your wages. If that $16K weren't spent on insurance, it could theoretically be available for other compensation or the company's savings, but in a competitive labor market, employers generally have to return it to employees either via wages or some other benefit to remain competitive. The $6,000 you paid is just the visible part of your contribution. The other $16,000 was paid by you indirectly, via a lower salary than you might have had if no insurance were provided. Thus, 100% of the $22K premium was ultimately paid by you, not 25%. The split between employer share and employee share is mostly about who writes the check, not who shoulders the economic burden. This idea that workers pay for benefits in the form of lower wages is not a fringe theory. It's the mainstream view among labor economists. As noted earlier, a Federal Reserve study stated that economists generally agree on this point. The consensus has been supported by empirical research. For example, studies have found that when employers face higher insurance costs, due to things like healthcare inflation or new mandates, they respond by slowing wage growth, or even reducing wages to offset those costs. Conversely, if health costs were to go down, or if an employer drops an insurance benefit, one would expect wages to eventually rise by a comparable amount, assuming a competitive market for workers. The labor market essentially treats benefits as just another form of compensation. It might be surprising to hear that all of the cost is borne by workers. One might think, surely employers share some of the cost, since they could just pay less total compensation. The key is that in equilibrium, the labor market sets compensation based on the value of the work and the supply-demand for that type of labor. If one employer tried to skimp by offering a lower total compensation, no insurance and no equivalent raise in pay, workers would likely go to another employer who offers a better package. So employers generally don't get away with spending less on you in total just because they offer insurance, they simply allocate that spending differently. Over the entire economy, the prevalence of health benefits means that baseline wages have adjusted downward from what they would be in a hypothetical world with no employer insurance. Put another way, decades ago as health benefits became common, explicit wages grew more slowly than they otherwise would have, locking in the trade-off. One policy analysis by the Cato Institute explains it succinctly. The nearly $1 trillion that employers spend on health benefits each year comes from workers, not from employers. Employers pay for health insurance by reducing other forms of compensation, mostly wages. Economists sometimes quantify this by saying that for every additional dollar an employer must spend on health insurance, workers effectively give up $1 in wages. It's a one-to-one trade in the long run. There are plenty of real-world illustrations of this principle. Consider the scenario when a new mandate or cost hits employers, say, a required increase in the minimum level of health coverage they must provide. If a law or market condition increases employer insurance costs, studies show new hires often get lower starting salaries than they otherwise would, or raises for existing workers are smaller that year. On the flip side, if an employer were to drop health benefits entirely, we would expect that they'd need to offer higher salaries to attract employees, or those employees would leave for jobs that do offer health benefits or higher pay. In fact, surveys suggest many workers would prefer higher pay in lieu of employer benefits in some cases. For instance, one survey cited in a policy report found that, among employers who don't offer health insurance, 74% reported their employees would prefer an extra $2 per hour in wages over health benefits. That $2 per hour roughly equates to what the employer would have spent on insurance. This again highlights that benefits are part of the compensation equation. Workers see them in comparison to cash. Why do employers call it a benefit? The psychology and origins. If employer health insurance is essentially funded by employees, why do companies insist on calling it a benefit and touting it as a perk? There are a few reasons, some historical, some psychological, and some practical. 1. Attracting and retaining talent. Offering health insurance is a valuable part of a compensation package because employees need and want health coverage. Especially in the United States, getting insurance through an employer is often cheaper and easier than buying it on the individual market, thanks in part to tax advantages and group rates. Employers know that a good health plan helps attract employees and reduce turnover. In fact, surveys show health insurance is one of the main benefits workers look for when job hunting. So from a recruitment standpoint, employers promote their health insurance offering as a benefit to make the job more appealing. It's a bit of marketing. They highlight that feature of the compensation package to differentiate themselves. The terminology of calling it a benefit reinforces the idea that you're getting something special. There's a financial reason rooted in policy. Employer-paid health premiums are generally not taxed as income to the employee. If your employer pays $5,000 for your insurance, you don't pay income or payroll taxes on that $5,000, unlike regular wages. This tax break dates back to World War II and the post-war era, when employer health benefits first became widespread. During World War II, the government imposed wage freezes to curb inflation. But in 1943, the War Labor Board ruled that contributions to insurance and pension plans didn't count as wages, allowing companies to offer health benefits to attract scarce workers despite the wage caps. This was effectively a loophole to compete for talent, and it worked. By war's end, coverage had tripled as many employers added health plans. The practice stuck, and in 1954 the IRS officially codified that employer-paid health insurance premiums are tax-exempt for employees. The outcome is that both employers and employees have had a mutual incentive to structure some compensation as health benefits. It saves on taxes for both parties. Employers can often deduct the expense, and employees don't count it as taxable income. Because of this tax exclusion, a dollar spent on health insurance is worth more to an employee than a dollar of wages, which would be taxed. So, employers frame it as a benefit they provide, emphasizing how they are taking care of you with health coverage, while also implicitly understanding that it's an efficient way to compensate you due to tax policy. Importantly, this tax benefit doesn't change the fact that the premium is still coming out of your total compensation. It just means the government is subsidizing that form of compensation. One analyst described the situation as coercing workers into letting the employer control that part of their pay for the tax advantage, noting that many workers aren't fully aware this money is part of their earnings. Humans tend to perceive something given to them differently than something they pay for themselves. Employers and society at large have long taken advantage of this quirk. By labeling health insurance as an employer-provided benefit, it feels like a gift or a favor. It's presented as, we care about our employees, so we give them health coverage. This framing can engender loyalty or appreciation, much like a gift from a friend or family member might. It also softens the blow of what would otherwise be just a reduction in salary. Imagine if instead of saying, we offer great health benefits, an employer said, we will reduce your pay by several $1,000s to buy you health insurance. The latter phrasing is actually more accurate, but it's also a lot less appealing. By using the language of benefits, the true cost is obscured. Many employees never actively think about the connection between the cost of their health plan and their wages. After all, they don't see that cost directly. This lack of transparency perpetuates the myth that the employer is giving something extra. In behavioral economics, this is related to the concept of the money illusion and indirect compensation. People are often bad at valuing non-cash benefits relative to cash. Employers simply take advantage of that. They know employees will value the health insurance highly because it is valuable coverage. And by bundling it as a benefit, it feels like a plus rather than part of a zero-sum trade. In summary, Employers call it a benefit both because it is a valued part of compensation important for attracting you and because the wording and presentation lead you to feel taken care of, rather than realizing you paid for your own healthcare with foregone wages. The history of how this all started, with wage freezes and subsequent tax preferences, set the stage for employer insurance to be the norm and to always be spoken of as a benefit. This language has become so standard that even employees refer to it as part of their benefits package, seldom pausing to question that phrasing. It's time to dispel the illusion once and for all. Employer-sponsored insurance is not a gift from your company, it's part of your earned compensation. Your labor is generating the funds that pay for your health plan. The employer is essentially an intermediary, taking a portion of what would have been your gross pay and using it to buy insurance for you. In a very real sense, you wrote the check, even though it's the company's name on the check to the insurance carrier. This arrangement can be thought of as a sleight of hand. With one hand, your employer offers to pay your hefty insurance premiums. With the other hand, they adjust your wage offers and raises to cover that cost. You end up feeling grateful for the insurance support without noticing the corresponding hit to your paycheck. As one Federal Reserve economist noted decades ago, what employers spend on health benefits passes on to workers in the form of lower wages. In more direct terms, every dollar your boss spends on your health insurance is a dollar less in your paycheck. It may not be labeled as such on your pay stub, but it's a real cost to you. Indeed, if health benefits vanished and all else stayed equal, economic theory and evidence suggest that over time workers would demand and receive higher pay to make up the difference. The fact that this doesn't happen, because benefits remain prevalent, is exactly why we say workers are paying for their benefits. They have already traded off higher pay for those benefits. None of this is to say health insurance isn't valuable, or that employers are evil for structuring pay this way. Health coverage is extremely important to most people, and having it provided through work can be convenient, and due to tax breaks, financially sensible in our current system. The goal here is simply to unmask the true payer. When you hear this company pays $X toward your health insurance, translate that in your mind to, this company is allocating $X of my earnings to health insurance. When you see the word benefit, remember its literal definition, something extra on top of wages, and recognize that employer health insurance doesn't actually meet that definition in a financial sense. It's not extra, it's part of the whole. So, the myth of ESI as a free perk should be laid to rest. The truth is empowering. If employees collectively understand that they are footing the bill, they might demand better value for those dollars, whether in the form of more affordable health plans, higher wages, or a say in how their compensation is used. In later chapters, we will explore the implications of this reality, including how this hidden cost impacts wage growth, and what alternatives might give workers more control. But the first step is awareness. The next time someone refers to health insurance as a benefit from an employer, you'll know to respond, it's part of my compensation and I'm ultimately paying for it. In fact, you've been paying all along. Key takeaways. Benefits are supposed to be extras. By definition, an employee benefit, like health insurance, is something provided in addition to your wages. However, in the case of employer-sponsored insurance, it's not truly an add-on, it's funded out of your own compensation. You bear the full cost via lower wages. Workers pay the entire cost of employer health plans in the form of reduced take-home pay. Decades of economic research confirm that for every dollar an employer spends on health insurance, wages are lower by $1. In essence, you are paying 100% of the premium, just indirectly. ESI as a gift is a myth. The idea that your employer is generously giving you health coverage is an illusion. In reality, it's a portion of your earned pay being channeled into insurance. Far from a free perk, that benefit is one you've been financing all along through foregone wages.